Hey everyone, it's Tom Suvansri, Premier Trust Advisors. I'm glad you're joining me today. I want to cover a quick topic for you on how banks make money. And you'll quickly see how they can generate such sizable profits from their activities. So in a normal situation, right, we have money and we use the banking system. Whether we open up savings or checking accounts or money market accounts or a CD, we're giving our money, we're loaning our money out to the bank, and they're going to pay us a rate of return on that, an interest rate. And in today's low interest rate environments, it's maybe say 1%. There might be higher situations, but we'll go with 1% today. So we've loaned them our money, and they're going to give us a 1% taxable, unfortunately, rate of return. Now, they're going to take that money, and because of the way the fractional reserve lending environment works, they're able to loan up to 90% of that and keep 10% on reserve, just in case we want to get our money back. And so they're going to loan that money out, in this scenario, say at 3%, to someone who's buying a car, who wants to purchase a car, and any car loan or any other loans. They're loaning that out, and essentially what they're doing, they're marking up money. They're going to take our money, $100, pay us $1, and then loan out that same amount and get $3 for it. Now, over the course of a year, that actually equates to 200% return. Now, that's a pretty sizable amount. They're basically marking up money to get that rate of return. They're not using any of their money in this situation, and they're just we're lending our money to them, and they're subletting our money out to someone else, and they're managing that transaction. So, and as I mentioned, in the fractional reserve lending environment, that can happen multiple times across the banking system, and through quantitative easing, and when they infuse money into the economy, it's expected that, say, $1 billion gets into the economy that's created, it actually takes the effect of $5 billion because as it runs its course through the banking system. So why wouldn't a bank just use their own money? So let's take a look at what that looks like. So in this same scenario, they want to loan out the $100 to someone earning 3%. So they got to put $100 their own money in. And their future value they're going to get back is $103. So obviously, it's a much lower rate of return. They're only going to get 3% in this scenario. And they're only going to do that once because it's their own money. So this really points to the power of leverage and OPM, using other people's money to generate more cash. This is one of the big key wealth builders that the wealthy use to generate more income, is to leverage other people's money. And certainly this comes with some debt, and for some this may be considered very risky. But done in a productive and safe way, this can really help boost your wealth. So let's take for a real world example. How do we apply this principle to our own world? So imagine a situation where you have an asset you've built up, and you can leverage that, use it as a piece of collateral. And we call it a home, a cash value life insurance policy, whatever. And you can borrow from that at 6%. And what if you found a cash flowing investment that could earn you 10%? Now, over a course of a year, that equates to a 67% return. Not the difference of 10 minus 6, 4%. It's actually a 67% return because you're using other people's money to generate more income for you. So this is terrific because the underlying asset you used as collateral is undisturbed. It continues to grow. You don't have to drain that account at all. You just use it as collateral, and it allows you to continue to build your wealth and have your money move, not just sit stagnant in an account. This is a way to consider building your wealth in a different way by using multiple streams of income. So I hope this was helpful, and it shows you the power of using other people's money to generate great wealth.